So this webinar is about the future of real estate industry and its components. It was organized by SolidBlock and Knotel. SolidBlock is a technology platform that transforms real estate into a tradable financial product. And we're essentially a prop tech company that puts real estate on the blockchain. Knotel is the world's leading workspace platform that matches, tailors, and manages space for customers. With over 5 million square feet across 200 plus locations in 3 continents, Knotel is transforming commercial real estate and moving companies forward. So Melissa, the head of marketing east at Knotel, is one of our panelists. She's going to be starting shortly. Additional panelists today include Adam Horowitz from Lever Capital Partners and Julio Gonzalez, the founder and CEO of Engineered Tax Services. Now, a few words about how the event will follow. So we'll start with Melissa and the thought that has been on everybody's mind. So will we ever go back to work in an office? What's going to happen to retail centers? What in the world are these companies going to do if in the face of new challenges, as well as the transforming reality that we're facing in this situation? So we'll talk to Melissa about that. We'll follow with Adam about the overall economic impact and what the investors should be doing, what the developers and sponsors should be doing in the view of the current pandemic and what's going to be happening afterwards. Now, then we'll on with Julio about what the government is doing to help this overall situation, how investors should be using the incentives and the tax breaks that are given to them, what to expect, when to act, how to act. So these are all the questions that we have on everybody's mind. Now, we received a bunch of questions from you guys, and we're going to incorporate them throughout the panels. If you have any additional questions throughout, just throw them in a chat. If I have some time to ask them, then I will ask them. And if not, we'll get in touch with you afterwards and provide you all with answers. We hope to cover everything, right? So now let's start with Melissa. Melissa, how are you today?
Good morning. Yeah, I'm doing great. Thank you. And thanks for having me. I am so psyched to be having this conversation. I think it's on everyone's mind. And thank you for hitting the high notes on Knotel and what we do. My personal role with the firm is head of marketing for Knotel's East Coast, which covers New York, Boston, and Washington, D.C. And right now, talking globally with everyone on my team about the future, what our communications are going to look like, and what the world is going to look like.
Okay, very, very interesting. So we all know that the office space, along with the hospitality, has been hit very hard. Now, will the office industry recover, and what will it look like in the future? What is the typical office going to look like? What is kind of new reality that we're expecting here?
Yeah, definitely the $1 million question. And it's an interesting one from our perspective because Knotel has always been a work from home culture. But I think in the very short term, if not imminently, work from home technologies and platforms will be an essential, and they're happening right now. So anyone who is built with that in mind, in their backbone, their technology, their support for their staff is thriving and able to keep business running. And anyone who hasn't had that in their plan is actively creating it now as we speak. I don't think it's going to be a nice to have. I think every culture and company will have a work from home policy. And that's going to also change the way we reimagine workspace in terms of the brick and mortar. I think you're going to see much more open office designs. Spacing is going to change. Owners and operators, we're going to have to deploy methods, really risk-proof our workspaces, so to speak. And really drill down to the operational level of our game plan. I don't think anyone could have prepared, was prepared. I don't want to look at, an Apple or a Microsoft or an Amazon and say they did it right. I think everyone is figuring it out as they go, big, small, startup, Fortune 100. But I think what is certain is that risk-proof workspaces, better HVAC systems, different cleaning procedures, those are going to be topics of norm. And Knotel is on the forefront of how we position ourselves as advisors on those themes for all of our customers.
Great. Yeah, those are really definitely important points. you guys are innovators in the real estate space, especially the category called prop tech, property technology. Now, with most startups across the spectrum experiencing trouble raising funds and staying afloat, what does that mean for innovation in real estate, the industry that definitely is going to be hit hard, within the next few months? And will we see a slowdown overall in the prop tech sector? Will we see new startups maybe coming up and solving these challenges?
Sure. I think every company, like I said, from startup to Fortune 500 and beyond, has to be aligned with a flexible workspace plan. So I think you're going to see a slowdown in traditional leases, meaning the 5 to 10-year lease mandate is over. It's a little too soon to say if you're going to see what the stats are. You're going to see them, but what are the stats on startups folding or changes in the sector per se? What we've seen so far is from our customers alone, if we're looking through a micro lens on Knotel customers globally, there's something that we are calling a run on the bank, which means everyone's holding on to cash. Cash conservation mode is in process right now, whether you have it to spend or you've got a shorter runway, which can lead to the obvious downsizing, retooling of business models. But on the flip side of that, there's obviously companies that are going to be well positioned to grow once business as normal resumes. What is business as normal? When will it resume? Those are things we're waiting on. But I think there are opportunities to capitalize off of the future needs if we can all look at our crystal balls and anticipate the obvious. Technologies that promote work from home. Zoom is the perfect example, completely well positioned. Everyone from a workout instructor to this conversation we're having right now is using Zoom meetings. And I know there's others out there. How are those guys going to differentiate themselves? So I think you're going to see highs and lows. I think you're going to see business models change. I think prop tech is still going to be a thing, to answer your question. It's just going to have different categories. It's going to have subcategories of what we originally thought it was.
Yeah, maybe like a work tech within
Exactly.
the prop tech.
Exactly. I think the focus on business ops, anyone who touches business operations right now is in a really good spot.
Yeah, awesome. So you're talking about office from home. Are people going to be reluctant to kind of get co-working space? Will they just reconvert their home space to an office, as I have done by just putting up a stand-up banner?
I mean, I think, well, if you're worried about sharing space, is that the question? Are we going to be going back to share space? Well, so one thing about Knotel, just to clarify for the general audience, is Knotel is not co-working. We never have been. We've never offered shared environments or amenities. Think more of like the traditional office space user that shares the lobby and the common corridors. But beyond that, all of our spaces are uniquely built for individual companies. So as companies come up with their own idea of what the new normal looks like, we're going to be well equipped to build that for them and rapidly. So our go-to market time in terms of turning around spaces is going to be, and always has been, about 60 days on average, depending on the time, construction needs, permits, etc.
Nice.
But so our business model has shielded us from those kind of issues. It's really going to be up to the leaders of companies to decide, what does my culture look like now? What are my people going to be comfortable with? How bad is my area of the world been affected relative to the commutation needs of my people? So I don't think it's a one size fits all answer, but from a Knotel perspective, we're just we're thrilled that we've never been in the bucket of shared space. So, and not that that's not going to be of value. I think a lot of companies thrive on having the networking potential of others around them. But what will networking look like? Maybe it'll be more Zoom meetings. Maybe it'll be more virtual cocktail hours, so that is all evolving as we have this conversation.
Okay, we'll have some cocktails on Zoom. Guys, thanks very much for joining. I see that we got a big party here, 180 people so far. For those of you who are just joining right now, we are talking about the future of real estate. I see that some people are already writing on the webinar chat. I'm not sure that everybody gets to see this. This is public, or Lorraine, if it's possible, we can make it public. We could. I see that Matt Hoffman of Housing Tech is writing. I agree that PropTech will start to be more specific about the channels within real estate that a solution company is serving. And then Lital August Harrell is asking, what about new construction? Do you have a crystal ball on that?
Construction in New York is on hold unless it's essential to government support right now. So if someone could tell me when Governor Cuomo is going to change that, I'd be very happy to know that answer. But our current construction projects have halted. I believe as of last Friday was the official stop work date. So we are in adherence to the law right now. But I don't foresee, I think that's going to be one of the first things to come back online. It is a driver of every economy, not just New York's economy. So I'm hopeful and bullish that, people will want to see the economy start moving again sooner rather than later. And there's no bigger driver than construction. So fingers crossed.
Okay. So as far as New York City is concerned, are you from New York? Where is your beautiful house located?
Oh, yeah, I'm a New Yorker for 20 years, originally from Connecticut, relocated right now in Sag Harbor, sheltering here, just kind of getting outside of the epicenter. But New York is home. I have spent 20 years in cycles of real estate in New York. It initially felt a lot like 9/11. I don't know if anyone lived through 9/11 in New York City. I certainly did. I was a lot younger. I was a lot more naive. I thought this was the biggest catastrophe that could ever hurt America, especially New York City. The one thing I did learn is it was a cycle. Like, this will be a cycle. There will be a bottom, there will be opportunities at the bottom, and there will be a rise and change. So those are the only things I know for certain, is that we will cycle out of this. There's opportunities to be had right now. If you don't have the fear, you can certainly see them.
Great. And how do you think the New York real estate industry might cope with the after effects of the pandemic?
100% New York is resilient from a real estate standpoint. I think you're going to see institutional REITs. You think you're going to see flexible workspace operators like Knotel. I think you're going to see industrial office owners really start to channel their energy. I think warehousing is going to be a thing. I think with more and more online orders due to necessity from the pandemic, I think industrial owners that can warehouse, whether it's locally in New York, and typically New York's not used for that use per se, but I think with a lot of vacancies, you're going to see absorption from that sector. I think in institutional REITs, the SL Greens of the world, I think they will always be around. They will always have a core product, a brick and mortar product for corporations. And I think co-working and flexible workspaces is going to remain intact. I don't think every operator will survive. I think, how long is your runway right now is a real question. And we'll soon start to see who's lean, who's mean, and I think only time will tell. But those are the sectors that I see coming out of the New York market that will always be around.
Yeah, absolutely. So let's go back to Knotel. One really cool thing that I heard is that your CEO even offered to convert empty office spaces to medical assistance centers. So how did the landlords take that, and how has the response been to that?
Yeah, so far we're in preliminary discussions. It is a landlord conversation first and foremost. The project is called City Spaces, and I will share with everyone on this call participating a link to our site that explains what it is in greater detail. But effectively, we've got vacancy. And if we can do anything right now, if we're not operating under normal business circumstances, if you will, we want to be doing something for the general good of the population with the vacancy that we have. So if we're not using it, we want government to use it, medical to use it. The question becomes, are owners comfortable? Are the sizes of our spaces meaningful enough to house what needs to be housed? So ask me again in 30 days. Amal Sarva, our co-founder, just announced it last week, so it's a little preliminary, and I will be circulating the link where you can see updates on that. We've been talking to brokers who are marketing spaces for similar purposes and trying to join forces. So it's really a collaborative New York City effort and focus to triage. And if we can use our spaces for good, we certainly will right now if they're not occupied.
Right. So I have two interesting questions for you, and one is tied to the other. I got a question from Rohit, actually prior to this webinar, about with the entire world on lockdown and very low occupancy levels in commercial buildings, will that lead to a sustained decrease in demand, rental rates, and so on? And I have a question here from Tammy Lindberg, talking about specifically Knotel. What will happen to the company, and speaking about the financial health of the company, especially after Friday's layoffs. We've heard some people talk, but what I saw, actually, I saw a few people talk, the people that were laid off, and they were talking about the company very favorably, which is very unusual, how much they loved it and their understanding, Yeah.
It was honestly a very bittersweet day. Friday, a lot of good friends are no longer with us. And these are people that were actively recruited. These are brilliant people. I've never worked with smarter people or a kinder culture. Real estate has a reputation of being harsh, and this was the antithesis of that. And it's sad for me. And if you do a search on LinkedIn, to your point, what blew me away, and I've never seen, is almost every single person who was let go put out such a thoughtful thank you to specific colleagues who made a dent in their career and their lives, who they learned from, who they created with. I mean, we still have an unbelievable product that's very relevant in this market, but we want to make sure we can last through the cycle. And I think because the cycle is unknown, our leadership had to make tough decisions that we're not alone in making. I think all eyes are on Knotel because we were second in size post WeWork. WeWork got a lot of press, and we got, for whatever reason, even though we're not co-working, we tend to get brought into that bubble in terms of analysis by reporters. And quite frankly, Knotel does have enough runway. We kept people who could keep this company afloat, whatever it becomes post-pandemic, and our business model will 100% change. How we are going to position ourselves will change. That is for certain. We just didn't need the same size staff to get there. And we are in cash conservation mode, as I think every single company in America is right now. So I think it's a great question. And we hope to be around to serve you. I mean, if I could say in 60 days, we're business as usual, I'd love to say it. We just don't know right now. But we're well equipped, and we've got what I like to call the dream team remains. The people who let go, we are actively trying to help replace them and reposition them. And if any of them are listening to this call, you know how to find me. And please, if you guys get an outreach from a Knotel employee, just know that, like everyone else, this was not their choice. This was not their fault. This was not poor work product. This is horrible timing, just a horrible situation in general for the global economy.
Absolutely. So thank you for that. And I think it's important because many people right now are in the same boat, especially people working in this industry. So we have just about a minute left, and we covered all the questions, which is fantastic. So from the entire spectrum of commercial real estate, and you guys are involved in different types of it, what would you say your best bets for investment during the recovery phase and beyond? And who do you think will survive?
Yeah, I think, to my earlier point, any of the institutional REITs always make big comebacks. I referenced SL Green earlier. I worked for them in 2008, and I saw their stock drop to 8. And I said, geez, I'm going to buy this. I couldn't not. So I'm using them as an example of the comeback kid. I always bet on those guys. I spent 12 years building my career in real estate with them. So I think the Boston Properties, the SL Greens of the world, those are great bets. Anyone who's got a flexible structure, any kind of owner, a Durst who's got a flexible program in play, Tishman Speyer, to name a few that I know offhand. I think if you don't have a flexible plan and you're an owner and you'd like to converse with with Knotel about what that structure looks like and how we can do it together, because Knotel is actually in the process of talking to owners about management agreements and creating flexible programs in tandem now. So I'm betting on institutional REITs, flexible operators, and I would say industrial office suppliers who specialize in warehouse space right now.
Sounds great. So we'll see how that goes when the recording comes out.
Yeah, exactly. Let's come back and
compare.
see how my bets shake out.
Yeah, absolutely. Well, thank you so much, Melissa, for helping us organize this and for all your insights. Good luck with everything. And yeah, great. Thanks. Let's move on to Adam. Adam, hi. How are you?
Hi. How are you?
Great. Where are you speaking from?
So today I'm in Las Vegas. I'm from New York originally and moved out west about 10 years ago. So I spend most of my time either in Los Angeles, or today I'm actually calling you from my office in Las Vegas. So it's nice and early this morning.
Gotcha. So could you please speak a little bit about what you do in your company?
Sure. So Lever Capital Partners is a commercial real estate financial intermediary. It just means we arrange capital for commercial real estate projects anywhere in the US. And that means the entire spectrum. So it could be debt, mezzanine financing, preferred equity, or joint venture equity, either in the form of a limited partnership or a co-general partnership. Lever Capital Partners has been around a little over 10 years, and I've been in the space about 18 years, and my company is in a small consortium of sort of boutique firms that do exactly what I do. We comprise pretty much every major market in the US, and we average about $5 billion a year in financing across all of our firms.
Gotcha. Okay. By the way, Las Vegas was the last place I visited before the global lockdown.
Right.
So, you know, if maybe a few years down the road, we're going to talk about, you know, people talk about 9/11. Before the pandemic, that was the last fun trip I've ever had.
Right.
Well, I hope not. I hope not. So yeah, so let's dive into it. So how would you classify market conditions as you see them where we stand right now? Is it bull, bear, or something else completely unknown?
Yeah, I think most people don't really know. Everybody is looking at one of two things, and I think Melissa talked about it a little earlier. Is this a short-term blip that once this pandemic is over, is the market going to come back? Or is this the beginning of this pending recession that people have been talking about for a few years? So as it regards to commercial real estate business, and just thinking about it from the finance side of the equation, it's certainly in a holding pattern. There's certainly an economic impact, and people want to wait to see whether or not this thing is going to come back quickly. But in the meantime, there are lots of people swooping in to try to solve the problem that's been created. The one thing that you've seen very quickly, and this happened after, I think, again, Melissa brought up 9/11, are these the CMBS deals and the CLO transactions, which are essentially these deals where they pool your capital. If you saw the movie The Big Short, it's kind of alluding to that. That business has been shut down for the last couple of weeks. So deals have to get financed. Money moves, whether or not the market's going up or the market's going down. And we kind of help on both sides of it. So the question is, what's happened since those markets have been shut down, and who's going to swoop in and solve some problems or take advantage of opportunities?
Yeah, absolutely. So everybody, I see that we still have a really good attendance, and it's going up. So keep the questions coming. You have the chat function in the bottom of the Zoom. Make sure you write them to all panelists and attendees to keep it a fun gathering. You know, bring your cocktails. So Adam, so what are the general trends that could be expected during the pandemic and afterwards in terms of real estate investing?
Yeah, again, just thinking about the finance, what you're going to see immediately is a massive amount of assets that are in default. It's going to happen very quickly, if not tomorrow. when you look at the hospitality space, clearly that's going to be the easiest sector to look at and just say, right now, it's going to be a big problem. Every single hotel in the United States will essentially be in some sort of default as of tomorrow, likely in a non-monetary default, essentially meaning that the lenders of these assets need the loans to be in a good position whereby there's more cash coming in than the mortgage. And obviously, given what's happened in the daily leasing cycle of the hotel business, that's not going to happen. The other sectors, which I think you brought up in your opening, are really the retail and office sectors. You're seeing clearly people in the retail sector, they've already shut down their businesses. It's not that it's just dark because they're not allowed to open. It's because they shut down and they're not going to be opening back up. This could be anywhere from a lot of the restaurants that have already given notice, as well as smaller retails that just don't have enough cash flow, working capital to stave off this thing and wait it out a few months. But again, there's a lot of capital that is trying to solve this. So for all of these CMBS and CLO deals that fell apart, there's another lender behind them that says, okay, you were looking for some sort of a 10-year long-term fixed rate financing. So I can't provide you that, but maybe I could provide you a 2 or 3 year runway. Or if it's very expensive money, maybe I'm going to provide you capital that gets you 6 months until these markets open back up.
Gotcha. So you said tomorrow, April 1st, and not because it's funny, but because the rent is due, right?
Yeah.
So what are we? Yeah. So we're gonna see lots and lots of angry commercial companies trying to collect rent and not getting that. And we'll talk to Julio afterwards about that, about what you can do to mitigate that, right? In about 10 minutes or so. All right. So I got a question from Rohit at Amara from India. A lot of opportunistic buyers would try to purchase real estate at this time when the rates are low. In case properties are sold on amortized payments basis, what would the advice to sellers be to not lose out on the market price corrections on the property?
Well, the sellers, it really depends. I mean, do you have to sell, or do you have the ability to hold on to some asset for a period of time? I think it's very specific as to what city you're in, what the asset class is. If you're looking at some sort of, let's say it's an industrial, center that's maybe used for distribution, and you have long-term credit tenants that are coming on board, then maybe you'll hold on to the asset and wait for the rest of the market to come down. If you need to sell, then you have to kind of think, is this the right time? Do I feel comfortable? If you think that the retail and the office sectors are going to go further down, maybe you want to sell now because you think it's going to drop another 20 or 30%. I think every situation is certainly unique with regards to the asset classes. It's really hard to just generalize about the entire market as a whole, but there are going to be opportunities, and we could certainly talk about that, or other panelists might talk specifically about what those opportunities might be, how you might find them, and then the biggest thing from my side is, how do you finance it, right? How do you acquire an asset if you think there's a great opportunity in front of you?
Right, and what is the answer to that question?
Cash is king. So this is not anything new. Certainly, as Melissa stated earlier, she's been around a couple of cycles, and so have I. And for the people that have been around the cycles and are looking for this opportunity, they've been waiting a long time. So we know lots of investors that we were talking to, in 2019 that just said, we're selling everything. We're selling every single thing that we have, and we're going to sit on the sidelines and we're going to wait. We're going to wait for some opportunity. And if that took 6 months because there was some odd thing like this that popped up, or just in general that the recession, signs of recession started coming, they were going to wait and to pounce. And really what that is the ability to close quickly with a lot of cash on hand, because these opportunities, when they come about, if you don't act quickly, they're going to disappear very quickly.
Got it. So this period obviously is going to last some time, right? This recession, a few months, 6 months, 12 months, nobody knows. How do you know when is this moment where it reached the absolute bottom?
You don't, but you don't need to be at the bottom. I think when you look at the cycle itself, right? and you look at where do people typically buy, right? The average person who's not looking at these long-term cycles, who tries to convince themselves that things will go up forever, they'll be buying it on the upslope, and they'll be buying it as it's just about to start coming down, and then they stop. The really savvy, smart investors will acquire assets, even as the knife is falling, they're okay with it. They want to get it somewhere in that bottom half of the trough. So anywhere in there, they're fine. If they catch it as it's halfway down, and it's still going down, they're okay, because they're going to catch all the upside on the other side of the equation. So they're not focused on necessarily getting it perfect, but they want to be on the bottom half of that cycle.
Got it. So what about the investors that haven't, weren't so savvy and haven't liquidated their holdings until the disaster struck? What should they do now? How can they hedge or secure their investments? Should they sit on it? Should they wait out?
Yeah, I think the big thing is it's funny because a lot of these things I'll talk about are sayings that have been around a long time. So the cash is king, right? I didn't make that up. People have been talking about that for centuries. And the next one is the same thing. It's called not putting good money after bad, right? So the concern is looking at your asset and saying, if you take the emotion out of it and you step back and you look at your asset and say, what's going to happen to my tenancy? Because Melissa's talking about sort of a changing marketplace in the office space. Are rents going to go down? What's going to happen? And if I think rents are going to go down, can you take the loss? Can you take the loss now? Can you sell it and get out of it? And not put what they say, good money after bad. But if you're in a good economic environment, you have the right tenants, and you've been able to make those modifications to the asset that you own, then maybe it's a good time to backstop it, to secure the investment, to make sure that this thing's not going to go into bankruptcy. Somebody's not going to try to buy your note at a discount and try to foreclose on you the second there's an opportunity. And there'll be a lot of those vultures out there just waiting for that to happen. So I think you have to pay really close attention to what you own and whether or not it's worth putting good money after bad or not.
Got it. Very interesting strategy. So as far as the investors that are developers, let's talk about developers and owners, operators. Is it a good time to start projects and that will be ready for sale or rent, whenever this thing is over? Or, should they also sit and wait and see what happens?
It certainly could be a good time, depending upon the size of the transaction. If you're doing, a triple net lease, single, small asset deal, I mean, they could put those things up in 6 months and you're maybe caught up in the middle of whatever is going on. But if you're you're developing a 300,000 square foot office deal, you really have to start looking at something 2 years down the line. What you're going to notice is, we always when we look at pro forma financials, we're looking at what we call untrended numbers. So what we don't want to do is say, okay, it's a certain amount of dollars per square foot today, and if we open up 2 years from now, let's see, there's a 3% bump the first year and a 3% the second year. I think what we do is we look at these things on an untrended basis. And then given where we're at, we'll maybe even discount some of the rent per square foot and see if the deal still works. And if it works at a discount to where you're currently performing the numbers and you have the right tenants, then I'd say I would go for it. The big question is, for any of these deals, any multi-tenant deal, so mostly in the office and the retail sectors, the big thing that lenders are looking for when they go to give you a loan is, what is the pre-leasing? And what you're going to now have to do is go back and look at your list of tenants that have signed contracts for pre-leasing of the transaction and to see if they're still there. Because what's going to happen pretty quickly is if you find out that 10 or 20% of your pre-leasing has now disappeared because they're now not interested, the likelihood is the lender of that transaction, whether or not it's a bank, an insurance company, a pension fund, is going to either retrade the deal on you, ask you to find new tenants, or just kill it completely.
Okay. So how about the recovery phase and the investor makeup? When you're talking about, these people who are sitting on cash, what are they going to invest in, or do you think their strategy is going to be more conservative or risk taking? What are they going to pick as their primary investments?
So I think there are two different answers to that. One could be there's an asset, even in an asset class I don't like, in a market I don't like, but there's such a discount because you purchased the note at a discount, because you got the deal through a bankruptcy attorney, and are trying to rescue something. So maybe you think there's a short-term ability to acquire an asset, try to re-tenant it or something and sell it. But the likelihood is the deals that people are going to invest in, you're going to invest in what you know well. So if you're a multifamily owner, you're going to continue to buy multifamily. You're just going to be maybe a little more peculiar about what types of assets you're buying. Maybe you're looking at geographically, you were within a certain range. Maybe you're going to make that range a little smaller now because you really know that market a little better than the market 2 miles out. Maybe you're looking at Class A multifamily because you feel that that will weather the storm better than maybe some of the Class B or Class C product, where a lot of the tenants are going to run into issues at this point in terms of their ability to pay the rent.
Sounds good. So what about you guys? And this is the last question for Adam for today. What are you guys going to do?
Well, as I said, we help buyers, developers with the financing, whether or not the market's going up or the market's going down. People need access to capital. So we spend a lot of our time in the bankruptcy world, not because we're waiting for that to happen, but because what we find are there are tons of not only real estate owners, but corporate owners of the companies that just happen to own a lot of real estate. And when the market turns down, they're going to need to look to those assets to try to pull out some liquidity to maybe solve some issues. So, if the market moves up, great. We're putting a lot of capital and arranging it for development properties, cashing out people who've maybe made a lot of profit. And as the market's going down, we're trying to rescue and solve problems for people who need access to different forms of capital to keep going.
Okay, well, thank you for that, Adam. Thank you for a lot of insights. I might send you some questions later as they come up. And I'd like to move on to Julio. Good morning. I don't hear you. I think you might be on mute somewhere on the phone. Yeah, we need to unmute you. Lorraine, could you unmute Julio, please? His phone is on mute. So while we're, Lorraine?
He's actually not on mute. Julio, you may need to, we're not able to hear you, so you may need to dial back in.
Yeah, on his phone icon, it shows him as muted. And it might be muted on the phone itself.
Well, let's see, one moment.
So while we're doing that, I want to share a few questions here that came up. Oh, okay.
Julio, you want to try?
Yeah.
Oh, you're there.
Okay.
Yay. Hi. Thank you for being so
Technology, I love it.
patient with all of this. And how are you? Good morning.
Hey, good morning.
So Julio, tell us a little bit about your company and what you do and your background in general.
Sure. We're the largest specialty tax firm in real estate in the country. We work with CPA firms and the real estate clients to make sure they maximize and optimize all the tax incentives from the federal, state, and local perspective to, basically generate higher return on investments and generate better capital structures.
Got it. So you've been doing what you do for a very long time, and lots of trends come in and go. 2008 had its own dimension. The collapse of the financial industries versus the collapse of the total market as we see right now. So your thoughts on how different the market opportunities would be resulting from the market fall at this time?
Yeah, I think this one will bounce back quicker. I think this is kind of a pause. I think, in these situations, we have winners, we have losers, and, but fortunately, we have a tremendous bailout package that I think can help us get through this from a market, and hopefully, this is just a positive time. But obviously, we'll have some losers that just don't come back, but from that we'll have winners, and we'll just adjust, and I think we'll get back on course.
Cool. So talk a little bit about the opportunity zones. I've seen some of your work in the area, because I think that this might be more important than ever. Tell us what is in the works and how maybe developers and investors can be using these regulations.
Yeah, I mean, the opportunity zones is such a tremendous once-in-a-generation tax opportunity to invest in communities that desperately need capital to bring back the revenues, the building, the infrastructures, and obviously the opportunity zones were having tremendous success, prior to this virus. It really generates from capital gains, and so, it'll have to reset. It'll be on pause for a little bit of period, but obviously it's a tremendous program from a tax standpoint to once in a lifetime get rid of gains and ultimately not have gains on assets that you invest in. So I think you'll see that come back as people start seeing gains from the market towards the third and fourth quarter.
Right. So, and in general, what is the government doing right now to incentivize investment in the real estate sector, or generally? I understand that they may want to hit pause and maybe kind of wait it out to not over incentivize, the time of the pandemic. So what is really the give and take here?
Yeah, I mean, the give and take is we just passed the phase 3 bill from the virus on last Friday. So dramatic opportunities here. So everyone that's in real estate should go online to the SBA.gov/disaster and go ahead and apply for this $2 million SBA 7A loan. So they say that $2 million loan will take about 2 to 3 weeks. They will advance $10,000 immediately. That's forgiven. And by the end of the week, the second program, which is the Paycheck Protection Program, which can be a loan up to $10 million, that loan is for wages, rent, utilities, and mortgages. And to the extent that the money used is for that, and you're able to keep some of the employees, those loans are forgiven. So right now we have those two programs in place, which are tremendous. Now, what we also did with the tax changes is we basically created the opportunity for real estate investors to immediately expense a lot of the assets called qualified improvement properties. So now they can restate those, go back and immediately expense them, which is a different change, which we had typically expensed those over 39 years. Now, that should create losses. And now what we've opened it up to is now that any losses created through 2019, we can go back now and amend prior year tax returns and get refunds. So look, we can use this new tax law to go back, amend the 2019 corporate tax return, generate the losses where we've changed the tax rules, go back, quickly amend the previous tax returns, get those refunds. That'll help with the capital. In the same time, apply for the loans, go in, apply now, get in line, and make sure you're getting that $2 million. And when the Paycheck Protection Program comes in place, that loan application will go in for that as well. And again, if you follow those rules there, a lot of that loan is forgiven. So on the 7A loan, it's 30 years, 3% interest. So there's tremendous opportunities for everyone right now. And I would also say for you real estate investors, help your tenants out with this too. I mean, they probably aren't aware of all these tax changes, but helping them get these loans right away can help them start getting back on their feet again. And, so we're a community and we got to help each other out.
Absolutely. Also, you have to help out your customers in the long term. That's going to help you out. Those are really, really useful tips, Julio. I have a question here from Isaac Corin, which I think is very interesting. We saw a government bailout in 2008. I'm not sure who we can bail out today, what kind of entities or companies. Do you think the government may do that with some maybe vital industries that are contributing most to the recession? Is that a possibility?
Well, in the loan package and the tax package that we just passed, obviously it's heavily geared toward retail, restaurants, hotels, and then beyond real estate, the airlines and some of the other biggest industries, right? So as we get back to traveling again, we'll start seeing the economy pick up and retail pick up and the hotels pick up as well. So those bailout monies are specifically for those industries. And so knowing these tax benefits for the bigger industries in the hotel, retail, and getting with your CPA and getting, and again, urgency, getting into this program right away and getting those monies within the next 2 to 3 weeks are so vital. I think this is a different bailout program really than we've had in the past, because a lot of these programs are forgiveness if you apply these to the right expenses and get back on your feet and get your employees back in and working.
I understand. Okay, so what about things that are in motion right now? So I have a question here from Frank Pilla about, he's been negotiating buying an apartment or an asset for the last few months, since before the pandemic, and got approved for a loan, a 65% loan. Should people that are in the middle, what do you think they should do? Should they buy, or should they stop everything and wait to see what happens?
Yeah, what a great question. Well, that's a tough question. I think you have to take a pause and see how long this thing is going to extend to. I would hope that, the banks and the institutions will allow us all to take a pause and see where this thing ultimately ends up. And if we're able to cure this quickly, then obviously rebound quickly as well. But I think I would ultimately take a pause right now to see where this all ends up.
Got it. So I have a question submitted before the call from Fred Ash from Commercial Realty Company. As a landlord representative and manager of several retail centers, I received letters from major retail tenants like Subway Corporate requesting 90 days abatement on rent due to virus crisis. I understand that a lot of people are using this letter, because I've seen this also from some of our clients that basically have extended their commitment to buy assets, ask for the same thing, right? So they cannot get any relief from mortgage companies. My question is, why would these large corporate tenants not seek federal assistance loans that are now passed to utilize in paying rent, instead of passing the buck onto the smaller landlords? It might be more difficult to obtain such a loan.
Yeah, I think there's probably little awareness. I think they should get right on to these loans. I think they should get those applications in right away. And us as landlords, I think we got to think about this as, restructuring their leases. So, basically giving some forgiveness there, making sure that we're working with our financial institutions on our debts, and making sure that we have a plan with our tenants where, maybe we forgive 3 months, but we add it back to a new lease. So I would redo the leases. I would put those monies into the future, extend the leases, and hopefully, and work with them again to be aware of these programs, but definitely get them online to get this done right away.
Right. Well, I can share what happened with WeWork, because SolidBlock was a tenant at WeWork. WeWork came to us and said that we can have 1 month free of rent next month, and then decide what happens. And I think that was really smart on their part, because I can imagine a mass exodus for anybody who can sever their lease in the middle, which is the case with WeWork. So I have a question about, just in general, your other hats. You have a family office and are working with many family offices. What's the word in the streets regarding the types of properties that they will be seeking? Is the distressed category the clear winner, or what do you think?
I think your speakers, had some good thoughts. I mean, obviously, maybe this is the retail apocalypse, and maybe it's the fatal blow to that industry. But as some of your speakers talked about, maybe these repurposed buildings that the REITs that have good balance sheets and are pretty strong come in and repurpose for industrial, distribution and things of that nature. And I think the information that was shared previously, that people are taking some money right now and going into the REITs that are very strong and have strong balance sheets, and obviously are at the lowest end of their stock prices with the ability to bounce back the quickest. I see the markets and the family offices trending that way right now.
Got it. So how about property owners and developers? We talked about, what they should do in terms of starting projects, but do they have any tools to protect themselves from a potential drop in their property's value, and what should their strategies be right now?
Yeah, again, I think we really have to be collaborative with our banks and with our tenants. I think we have to talk to our banks about, having some type of relief for a few months period. We have to go in immediately to these programs, the tax credits that have been established last Friday, the loan programs that have been established. And then, like you said, with WeWorks, right, they're going to give 1 month free rent. But maybe we go to our tenants and say, listen, we'll take 3 months off, but then we'll redo the lease and add it back to the end and, work it out. I think it all has to be collaboration, and I think we can get through this. I think it's just a, short pause in time.
That's a very interesting idea. I want to kind of maybe pitch it to different offices to take 3 months, off and then add it to the next lease. I think that's a great idea, Julio. Let me see if I had another question here from somebody about, mortgage payments. So what's going to happen to banks at the end of the day? There's not going to be any liquidity for them, from these payments from all the companies that have been hit. What do you think is going to happen?
Yeah, I mean, there's no doubt that they're going to be hit by this, but fortunately, we're going into a period where they had strong balance sheets coming into this, and I think that they'll have some relief as well from the government. So ultimately, I think if this pause is just a few months, I think the banks will be able to get through it okay. And clearly, I think working with the government is going to be helpful, because if we get these loan monies that are, basically given to the businesses, I think we can get back on track with the banks as well. I mean, that's what the money's for. And if we pay it, and we use it for the mortgages, that is forgiven, right? So we don't have to pay that part of the loan back. So that's tremendous.
Yeah, absolutely. Well, I think that this has been extremely helpful. We're going to try to transcribe this this webinar and maybe put it out in a blog form, because I think everybody should have this information. And thank you so much, Julio, for joining and for being so helpful and patient. So I have a lot of questions here, guys, from people who have been patiently waiting to hear about the blockchain aspect of real estate, which really is my specialty. And I have basically, kind of been working in the last few days through the pandemic to understand what the real estate is going to look like, talking to smart people like everybody on this panel in order to understand how these forces are going to change the investing realm for real estate. So what we understand is that the sectors are now reorganizing, right? So the hospitality is going to look completely different, and the office space is going to look completely different. Now, the long-term economic reality is not that of recession. I think it's clear to everybody here that it's, a temporary setback until we find solutions, and then life should be going back to normal. And that's good news. That if that's how the markets are going into it, then that's good news. However, we understand that real estate investing is going to be restructured. Now, what is clear is that liquidity seems to be a really important need in the real estate sector, because I think that right now, if companies had a way to still raise funds from other investors that they usually don't reach. Let's say companies or developers reach out to institutions, and now they would be able to open up to accredited investors or maybe even retail investors that are bullish on the market and realize that the prices have gone down. I think that it would give a great opportunity to many companies to even raise funds at this time. But since most real estate is not liquid, in fact, only 1% of all real estate in the world, which is valued at $300 $300 trillion is liquid. So SolidBlock is one of the companies that provides a technological solution to make real estate more liquid, transparent, and efficient. We have a blockchain-based platform that allows fractional investment and trading of real estate as any other financial product would trade. It's a tool for providing private offerings with digital securities that are in fact tradable. So we believe that with the new economic reality, we're going to see lots and lots of demand for our type of platforms, and we believe that within 3 to 5 years, it's going to be standard to offer liquid private offerings. And here is my kid and my cat. Okay, thanks for this. And see, the market is falling, everybody. Let me look at some questions here. I was asked, what about real estate tokenization and the STO? My company wants to do an STO. Well, I have to say that we've gotten a lot of requests as of late to help companies raise funds and to provide them with a tech platform. I have to say that, you know, we first have to look at the reality of what kind of products can raise. However, I think that any tokenized offerings are going to have much better chance because, again, the investor makeup has changed. A lot, you know, people who have cash and who are fortunate enough to be cash positive at this time are looking for things to invest in. So I think if we start putting projects forward in front of their eyes, you know, and enabling people to invest at much lower capital requirements, you know, which not a lot of developers can afford to lower capital requirement, you know, minimum capital requirement for investing to $20,000 or even $10,000, and that's something that you can do with platforms like SolidBlock. So I think that, you know, at this time, it's even more crucial to make that available. Let me see, what else are people asking? What is the future of real estate tokenization? Well, like I said, I think the future is that it's going to be pretty standard, and the current pandemic is just making it much more clear that that's going to be a reality for everybody. So we're coming up to an end for this webinar. Now, guys, first of all, I want to thank everybody on this panel. I want to thank Melissa, I want to thank Adam, and I want to thank Julio. Thank you for your time. Thanks to everybody who came here with questions. And I just want to make sure that you guys have all your questions answered. So I'm going to go through this chat, and I saw that there were many that I haven't been able to ask, that I want to stick to a 1 hour limit. So I'm going to make sure that everybody's getting their answers. Just make sure you write your name and your email address in the chat. And last thing I want to ask for you guys, we're going to run a little survey, just very, very quick at the end of this webinar, just to make sure that next time we do it, that we continue to improve and provide the best content for you guys. So just please answer this a little feedback. And again, I want to thank everybody for coming and being so forthcoming with questions and with your answers and with your knowledge. And I'll see you here. We're going to do this thing once a month. So soon you're going to get a notification about the next one. We have some panelists that already want to be on these, and let's rock and roll, and let's make this industry great all over again. Thanks, guys.
Yeah. Thanks, everybody.
Okay. How satisfying.